Right, a very good evening, ladies and gentlemen, and welcome to the second of our two-part special as we celebrate 20 years of S-REITs. Today's session is proudly organized by The Edge in partnership with SGX Group and REITs. I'd like to thank our sponsors, Elite's Commercial REITs, Mapletree Investments, and our exclusive events brokers, Tiger Brokers. There is a booth set up outside, so if you want to find out more about the Tiger trading platform, please check it out later. Now, without further ado, we'd like to start off this evening with a short clip from REITs.
Singapore is Asia's fastest growing REIT hub with a 20-year track record and an annual growth rate of over 13% over the last 10 years.
S-REIT today offer a diverse profile of global sponsors
with a total market capitalization of nearly $100 billion.
S-REITs dominate Singapore's IPOs and secondary offerings in terms of the amount of proceeds raised.
That offer long-term sustainable total returns and one of the highest dividend yields with lower volatility.
S-REIT are anchored by the Singapore brand name, which has always been synonymous with political stability.
High levels of pragmatic governance.
and efficient tax regime.
We have a conducive regulatory environment that was developed in close consultation with the industry.
There's also been great diversity in the assets being listed.
And vibrant secondary capital markets.
We have a very strong international and Asian institutional base that support the REIT product here.
The S-REIT industry was conceived because of the determined and unified efforts from multiple stakeholders.
We started in 2002 with just purely Singapore assets.
Singapore was coming into its own at the time as an international financial hub.
We had a vision to grow the REIT ecosystem in Singapore and establish ourselves as a global REIT hub.
Singapore quickly became an Asian REIT hub when Asian sponsors saw the viability and success of the initial S-REIT listings.
From 2007 to 2013, we saw a huge increment in Asia assets being listed as S-REITs. This trend has only continued to rise.
The founding of REITs in 2013 was to strengthen Singapore as a fundraising centre for REITs and to enhance Singapore's attractiveness as a listing centre for foreign REITs.
From Asian sponsors with their overseas assets, we are also now seeing the inclusion of sponsors from different global jurisdictions coming to Singapore to list their REITs right here.
The fact that most S-REITs hold a substantial number of foreign assets.
It's a clear validation of Singapore's transformation into an international hub for REIT listing.
This is a signal to Singapore that its governance and investment structures have a place on the world stage.
Singapore has now become a meaningful weight in the global real estate benchmark.
As the sector explores opportunity to further enhance its scale and competitiveness, mergers among S-REIT have been gaining traction in recent years.
Mergers provide S-REITs with more growth optionality.
Higher levels of gross revenue, net property income, and DPU.
Investors here will have an exciting time where they can invest into new asset classes, into the best-in-class sponsors, delivering them the best performance returns.
Sustainability plays an integral part in the future of S-REITs.
There will be increased demand for green buildings that integrate property technology.
As investors seek to invest in ESG-friendly real estate,
Providing stable and growing distributions over the long term.
The future for the Singapore REIT hub is bright and it is exciting.
There is an extraordinary investing power in Southeast Asia, which directly impacts Singapore as a global REIT hub. We see this developing considerably over both short-term and long-term future.
the sector will continue to further internationalize and develop in size and diversity.
The S-REIT track record over the past 20 years gives us the confidence that the next 20 years will see this innovation be embraced and implemented.
Thank you very much to Ritas. Now, you've seen him in the video, so let's put our hands together to welcome Mr. Ronald Tan, Senior Vice President, Global Sales and Origination of SGX Group, to give our opening address.
Mic test. All right. Good evening, ladies and gentlemen. Thank you for being here with all of us on a Monday night. Now, I know there are many of us here in this auditorium as well as some of us that are out there on the online as well. A warm welcome, and I want to thank especially the Edge for putting this together. It is stakeholders like the Edge that are very important in building this ecosystem in Singapore that helps bridge between investors, sponsors, and everyone here to better understand the growth of the Singapore REIT market. And of course, not forgetting our sponsors, Mapletree as well as Elite Commercial, for just being a part of this program together with REITers and SGX. Now, today I was asked to give an opening address, and I thought, how do we describe the last 20 years and the years ahead? So I will kind of make it simple and give some personal anecdotes of how we've come so far for the last 20 years. 3 Ws. What? What has happened in the last 20 years? If you look at the growth of the Singapore since the first REIT listing in 2002, the first 5 years of our REIT IPOs was mainly Singapore assets. Investors like yourself, retail, institutional, had a great time because for the first time, they could invest in Singaporean assets, tax-free returns, and it was exciting growth. But at the same time, we realized that Singapore was a small country. So we started to see Asian assets for the first time being put into the Singaporean REIT. Thereafter, the next 7 years of growth became a lot more exciting as we had assets that come from around the region, in India, in China, in Japan, in Australia, starting to come into the mix of our REIT. It reached a point where I remember about 8 years, slightly over 10 years, of which I'm still very young, I was invited by my colleagues in SGX to go meet some fund managers. And at that time, they said, look, Ronald, why is the exchange promoting so much overseas assets? Are we getting desperate as a country, as an exchange, to get more REIT IPOs? Why can't we just focus on Asia? And I remember having that very difficult conversation, but a very honest conversation that, while Singapore and certainly Asian is exciting, the reality is there is a bigger global marketplace that we need to scale up to. And particularly if we look at Singapore, there is a limit. And so over time, we have gone, and I think in the last 9 years, we have seen over 19 REITs that are listed on the SGX, all of which, or rather none of which, had any pure play Singapore REIT. So the why are we becoming a global REIT hub today? I think the REIT market in Singapore accurately reflects or is a perfect mirror of the Singapore economy. Much of Singapore starts with our home, but over time, we expand into Asia, and more importantly today, our Singapore enterprises are global champions. Likewise, our REITs have begun at home, gone into Asia, and today are global champions in their own right. And you investors together with us are enabling this capital market here in Singapore to be a platform of growth for our Singaporean and Asian sponsors to become global champions of the future. But that's not all. We are seeing, as you saw in the video earlier on, global sponsors from around the world beginning to come to Singapore to list their REITs of their global assets right here. And that's where I end with the last W. Where are we going from here? We believe that we have a vision, a future for Singapore REITs where we believe one day more and more global REIT sponsors, not just here in Singapore and Asia, but globally will say, if I'm going to list another REIT, where would that place be? And the answer in their minds will be Singapore. And when that happens, not only for us as a country, but for you as investors together with us, we will enjoy being able to invest in a greater diversity of assets from different regions, different asset classes, and importantly, getting the returns. It is a growth process. It's not a perfect process. We will get hard bumps, but we will learn from it. So tonight's session, I'm glad that it is probably more immediate about what's going to happen next. Are interest rates always going to be on the up? How long are you going to stay up? What sort of levels? How will that impact REITs? I'm glad I have with me on the panel later on two experts who can wonderfully answer all your questions of what's ahead, how will inflation affect the REIT market. But if there's anything we've learned from the last financial crisis is the REITs have grown stronger and we will continue to grow and scale up. So with that, thank you for joining us today, and I hope we have a very insightful exchange and a learning experience together. Thank you.
Thank you, Ronald. Ronald, please stay on stage because Ronald will be joining our panel of speakers tonight, and the discussion will be moderated by Ms. Gula Warden. She is the executive editor of The Edge. So please come on and join us. Besides that, we also have our esteemed speakers on the panel, Mr. Chye. He is the Deputy Group CEO of Mapletree Investments, and Ms. Shaldine Wang, CEO of Elite Commercial REITs Management. So during the course of the discussion, you may pose your questions to the panel. Just scan the QR code on the sides. Right, so without further ado, Gula, over to you.
Okay, thanks. Thanks. Can you all hear me? The mics are on. Yeah. Okay, great. Thank you for your kind words, Ronald. And our topic this evening is very apt for what's going on globally, risks and opportunities in going overseas. And I'm afraid we'll just have to go straight to Shaldine because let me say a few words about Elite Commercial REIT and Mapletree before we just go. Okay, Elite Commercial REIT is about 155 commercial properties, all in the UK, and all its revenue is in British pounds, and its DPU and NAV are also in British pounds. I think the last DPU was it 2.56 pence? As that half year,
Yes.
do we multiply it by 2, so you'll get what? Oh, more than 5p in the dollar. So for Elite, and its main tenant, I think for about more than 90% of your GFA and also your GRI, gross rental income, is the British government, which up to now has a AA rating. But we were just discussing earlier whether this will be maintained if it carries on with its current economic policies. Mr. Chua is the Deputy CEO of Mapletree Investments. Mapletree Investments is the sponsor for MPAC, which used to be MCT. We all know Vivo City. Vivo City is one of the best-known properties in Singapore, and it also owns lesser-known properties, Mapletree Business City and then some in Asia. Festival Walk, and also Mapletree Logistics Trust and Mapletree Industrial Trust, which I have a very soft spot for. But I think, yes, but yeah. So it has 78.7 billion in AUM across, well, office, we've talked about retail, logistics, industrial, and there's a student residence portfolio. And it says here that they're located across 13 markets, but basically Asia-Pac, US, and UK. So these are the two our two speakers who are the experts on currency hedging, interest rate hedging, because of all the foreign assets that they have. So Shaldine, you know, there was this question we had prepared: why are REITs going overseas? So what are the risks involved? And perhaps you could talk about your tenant,
Right.
What it's doing, and how does it impact you and investors in Singapore?
Okay, let me just share a bit of the experience that we've gone through over the years. When we first started looking at assets overseas, you know, things that are quite different from Singapore particularly are things like the tax rules, the structuring, I guess even down to the point, you know, how valuers are valuing the assets are different from what we are seeing here in Singapore. So, you know, they have a much more established real estate property market, particularly in the UK, the market that Elite is in. So when we go overseas as a Singapore, at that point in time, I think Singapore investors, these are the things that we need to be careful about. These are the things that we need to learn to build into the structure. So the other point that, you know, when we went overseas, we were quite adamant about is actually what currency. One thing is that we are investing in the UK property, our revenue is coming from the UK, so it's in pound sterling. Our expenses are mainly in the UK. So that makes sense for us to be actually denominated in that particular currency rather than having ourselves subject to forex exchanges. We are property managers. We are not hedgers, or we are not expert in FX per se. So I guess these are the things that we have always been looking into. We are always cognizant about the ever-changing environment. So things like last year, Elite Commercial REIT actually, after listing, went ahead and still look at the structure and try to see how we can actually maximize our structure and makes it more efficient. So we did a technical listing onto the TSXV Stock Exchange, meaning that there's no shares being traded on the stock exchange, but we are able to get ourselves listed as a UK REIT in order to enjoy all tax benefits that were given to our competitors or peers in the UK. So these are the things that as a REIT manager and investing into foreign assets, we'll have to consider much more than if we are just a pure Singapore play REIT manager.
Okay. Sorry, Mr. Chua, do you have time?
Yeah.
So hedging and currency. What is the best way to pay for foreign assets? What are the ways that REIT managers can limit the impact on DPU and NAV? Because your REITs have foreign assets.
Yeah, sure. Well, I think before I get to the answer, I need to preface and to reiterate what Ronald mentioned. I mean, the reason why we are a sucker for punishment and go overseas is because there's no more fun to play here, not because there's no more fun, but there's nothing to play around in here. So it's a question of whether you want to be a big frog in a small well, or you want to be a small frog in a bigger well around the world. And I think if you stay here, we'll just be stepping on each other's toes, right? So we have no choice, literally no choice, but to go overseas. And that also explains the recent merger that we have between MCT and MNET, because we find that for MCT to remain in Singapore will limit its growth potential. All right, so that was the main reason for us to go overseas. But going overseas also brings with it a whole plethora of issues, which Shaldine mentioned. And funding is a big problem. First of all, I think in terms of funding, there's obviously two sources: the equity piece and the debt piece. Equity piece is to try to explain to people like you why we are doing certain things certain ways. I mean, admittedly, most of the time we don't do it very well. That's why you always score us at AGM, all right? But we try our best, or the REIT managers try our best to explain to you why certain things are done in certain ways. And on the debt side is again another issue where we try to get the best out from our friendly bankers. But believe me, bankers are sunny weather bankers, right? When the sun is out, they give you the umbrella. When the rain comes, they take it away, right? So most of the time, we have to try and manage them. But I think the way in which the simplest way is always the best way. If you buy an asset in pounds, you fund in pounds. If you buy an asset in US dollars, fund in US dollars. There's obviously a cost. But some people take the shortcut because yen is super cheap now, right? Relative to US dollars and pounds. So why not borrow yen to buy pounds? But that is what we call carry trade. So in the times when the currency goes against you, you're going to pay through your pants, all right? And during the last crisis, some of the fund managers in Australia got really burnt because they used cheap dollar to go and fund US assets. And when the US dollars went up, no Aussie earnings could pay enough for them to pay off their debt. So I think this is something which is, I suppose, hedging 101. Always buy and borrow or raise capital in the same currency as what you want to buy. And then when it comes to protecting your income from coming back, because the first part is to protect your capital. The second part is to protect your income from coming back. So if you earn, say, for example, US dollar earnings, but your REIT is listed in Sing dollars, you've got to make sure that your manager protect your income coming back. That means your dividend coming back by hedging. But hedging is not free. The banks want to make some money from us. So there is a cost part of it. So how much you hedge, whether it's 90%, 80%, there's always a policy where the board will set. right? So there is always a judgment, and you need to trust your manager, trust the board, the manager's board of directors to do in the interest of the investors. So you got to choose. The first thing to choose is not choose assets, or the first thing to choose is choose the good managers, all right? Managers you can trust, because these are the people you are going to give your money to. Some of you are our retirement money, so don't play a fool with that. Right?
That's all you're going to say. Okay, so how, I have to come to you, Ronald, how do we get managers that we can trust, sponsors that we can trust? That question had to come.
Well, for starting, two good sponsors are here on the panel. I think for us as an exchange, I think in the Singapore REIT environment, we have a safeguard in that the REIT manager has to be a licensed fund manager, a full capital market service licensed manager. So that's one level of safeguard, obviously, which MAS, as the regulator, provides. But that's just making sure that they're in compliance with the law and the regulations. In terms of market acumen, like what Chye was saying earlier on, I think that's where track record is an important benchmark. How have they performed over the years? And obviously, once you're satisfied with the requisite track record, the other thing to really think about is the sponsor's strength, and in terms of also portfolio strength that they have as a sponsor group. Because the REIT is only the first part, it's only the beginning. And these are things that you would look at in the sponsor. And then lastly, obviously, are there related party transactions that we need to focus on? I think the regime here, and as you've seen, that we've tried to mitigate those potential conflicts as transparently as well as we can, but it is something that we should take note of. One last point I would say that people say that, if the fees or the performance are very expensive, that means it's not a good product. I don't think so. I think fees are just but one indicator. At the end of the day, we need to look at the total return beyond the fees. So if they're still delivering you a good total return despite the high fees, then perhaps they're worth the fees. So to me, fees is not always a benchmark. It is something we do look at, but I think we need to look at the requisite experience and importantly, are they able to deliver the returns?
Since you mentioned fees, Ronald, Chye, what's your view on fees? I've always felt, sorry, this is not in the questions that we sent. We discussed some questions before. I've always felt that the sponsor should take some fees in units and not all in cash, especially if it's, the performance.
Oh, okay.
Performance.
Well, there are two different schools of thought. The purist corporate finance experts will say that they want to pay everything out by cash. Because if the sponsors take units, right? Okay, there's some excuses by some managers to say there's an alignment of interest. Because if the units perform well, you also get rewarded well. So fine, I think that is one argument. The counter argument to that is that if you pay out fees over a longer period of time, it dilutes your holdings, because units are issued to the managers year in, year out. So ultimately, the sponsor or the manager gets more units, and the share of your dividend income in the future gets split into many more units. So you actually get less. So usually you will have a bit of a balance between cash fees and these fees in units. And I think the regulators, I don't know if it's SGX or MAS, has made it compulsory that any deals that are done within the IPTs, that means between sponsor and the REITs itself, the acquisition fee is always in units, so that you don't throw things into the REIT and then say bye-bye, run away, because your payment is actually in terms of the REIT units. So there's a bit of entrapment there, so to speak. But certain managers do want a bit of flexibility, because if they see that in the first year, for example, you buy an asset, say in London, the first year the growth may not be there. But in subsequent years, you can see that, for example, the thing grow by 5% per annum. The first year, you can afford to say, okay, I take less cash, I take more fees. Second year, when the thing has already grown up, then we say we reverse it, we take maybe less fees and more cash in terms of units. That is actually to help the REIT grow and to help you get the best distribution out of it. So there's no magic formula. What is important is maybe the formula for how you compute and get paid for the fees. And I think most recently, over the last five years or so, most of the REITs have adopted a alignment of this fees payment according to, especially for the performance part of it, according to DPU improvement, and not just based on pure the size of the asset that is under management. Because the accusation of the previous fee structure is that no matter whether it's DPU improvement to you or not, the managers keep getting more fees and more fees. They keep on buying, they get more fees because it's fixed as a percentage of the AUM. But now the thing has shifted, and I think it's a question of most of the new REITs listing have no choice but to follow suit to be competitive in trying to entice investors like you to not put money with them. So I think in today's context, I think the fee has actually come down quite substantially and more aligned with the interests of the investors. And I just to reiterate Ronald's point, the REIT managers actually work quite hard. So don't begrudge them the small fees that you are paying them. So after you pay them the fee, you still get a DPU. I think you should happily pay them fees. It's just like in Singapore, all my people, my friends in the IRA say, you should be happy you are paying taxes. That means you are doing well.
And for the record, it was Mapletree who set the pace, the change for the fee formula. So that is really to the credit of Tiow, Chye, and Mapletree.
Shaldine, what's your fee structure?
Well, we are a new REIT, so exactly like what
DPU growth
says,
okay.
Yes, related to DPU growth. And for us, when we first listed, our managers' fees was paid in units. But we have since do away with that. Exactly, a lot of investors has always been querying and asking. So since the beginning of this year, we have actually do away with that. We only pay managers' fees in cash so that there's no dilutions to our unit holders' base in terms of the DPU when it was given to them. So unfortunately, if we do IPT acquisitions, that will still be in units because that's under regulations.
Right, okay. So interest rates, right? So I know that REIT managers have no control over central banks, but REIT managers have their own capital management strategies. So how important are these to the REITs? Because we've seen some REITs which have, the Chinese REITs in particular, which have all the expiry on a single month. So could you talk a little bit about capital management strategy? How important is it? And after that, Shaldine, you want to go first? Or?
Okay, I'll go.
You go first, because you've had a long, MLT.
That's why my hair
listed
is
in
green.
Yes.
Okay, I think if you look at a REIT is a very simple cash box, right? And just bear in mind that underlying this cash box is a real estate business, right? We are not fancy investment bankers that wear three-piece suit. I was forced to wear this suit today, but normally I don't wear suit around, all right? So we actually are property guys, very simplistically spoken. And inside the P&L or the balance sheet of the REIT, there are only three components in the profit and loss statement, which is a revenue item, the expense item, and the others, which includes the capital management part of it, which are basically taxes and your interest rate and the hedging costs, right? So on the top line, the revenue, that's where the investment guys and now we'll go and hunt for new acquisitions for you. So that's what we normally call acquisition growth. Then on the expenses side, that's where you try to minimize property management costs and all your depreciation of all your other things that you cannot capitalize at the bottom, and all your utility costs, which is hitting us quite a lot today worldwide, except for some of the leases, which we'll talk about later on. Then at the bottom is the capital management. The top part is the responsibility of the investment guy. The middle part, the expenses, the property and the asset managers. The bottom part is where the CFO comes in. If that is not done well, I think you should ask the CFO to be sacked, all right? Because the capital management is trying to preserve whatever the top two guys are earning. So in the capital management, while we can have no control or no influence over the central banks, the CFO has got a plethora of instruments there, right? From trying to structure different types of debt, right? and also the sources of debt, whether they are floating debt, whether they are fixed rate debt, or they do swaps, or they do in terms of trying to do bonds or perpetuals and all these things. So I'm sure you have come across all these things. And importantly is that you should try to see if the CFO has done the job by hedging out all the loans, so that not all the loans are due because they are on floating. Floating is obviously the cheapest, right? So what you gain today, tomorrow, if, for example, the FOMC decides to hike the interest rate by 100 bips, accordingly, though, the interest rate around the world is going to go up. So whichever currency you are in, you're not going to be spared. So you need to be able to hedge it out. Normally, on the average, I think the S-REIT will hedge out to about 3 to 4 years. But they are not saying that, like what Gula mentioned, hedge everything, you become a pillar at the end of the 4th year. Because if the 4th year come around and then you're in a bad market, the banks are not going to take away your umbrella, right? And you got nothing to fund it. If they're nothing to fund it, what they will do is they will come and see you and ask you for equity to replace the debt. So the so-called wisdom is each year let about 20-25% of the debt to be expired. So that it's not a skyscraper, but your HDB flats along the way. So that it's 12-story, so that each year you can afford. And even if you cannot afford for that year, if they come and ask you for some equity to replace that, it's not going to be the end of the world. All right. So some of these, but I think obviously a mix of floating plus some fixed rate, a mix of some of the bonds, a mix of perpetuals. That's what makes a more stable kind of a debt profile. Equity is equity, all right? Equity, you don't need to assess whether the deal that they are buying. No, I think none of the REIT managers are going to raise equity for fun unless they are super performing ones that are trading at 1.10 times, 1.5 to 1.8 times. They will not go and raise equity from you, because raising equity when you are trading at a discount is super expensive, and none of REIT manager will want to venture into that. Sometimes you have no choice. In my earlier days, I had to go out and raise equity for MLT when it was trading at a discount. That was because there was a deal that had to be completed, and the bank wants a certain LTV, so we had to raise some equity. And believe me, every investor we went to see, whether they are institutional or retail, scolded us upside down. And that's probably about one of the most miserable time I had as a REIT manager, right? So my advice to REIT manager, don't go out if you don't have to, especially when you're trading at a discount to your trading price, your NAV. So I think on that, the job of the REIT manager is actually quite extensive. Aside from trying to get revenue in, expenses down, is to make sure that they protect the cash flow so that whatever drip out can be distributed to you. So the REIT manager's life is complicated, but not that complicated. So if they do their job well, you will get your money back.
Shaldine, is that right?
Agree, totally agree with that. I guess if you are like Mapletree, who has got a long history, it's quite easy to manage up the blocks. So, well, for us at Elite, we are still a young REIT. We've been listed just 2 over years ago. So we also started to break it out, and that's exactly the intention of the REIT manager. So we've got the first tower when we did our first acquisition, which is our first portfolio. Then when we did the second one, we actually extend that as well. So that's another tower. Eventually, over time, that is our aim, to work towards whereby, you have some expiries. You could be every year, every 2 years, but it should not all be concentrated in one single year. So that's the objectives. And for us, I guess the other part would be hedging. We are denominated in pounds, so all our expenses are paid to the banks in pounds as well, because we borrow in pounds. But having said that, the interest rates has been moving. We have been seeing all these hikes from Bank of England. Even as of last Thursday, there was another hike again of 50 bips. So these are things that we can't control. What we can control, of course, is how much swaps you are having in your books, how much fixed rates you are able to get, so that you could ascertain the level of interest that you are really paying. But I won't advocate to say 100% swaps, because swaps comes with a cost. Yeah. And also not when at this point in time where you have already got your loans in place. You know, there are investors that's asking, why don't you just increase your swaps now? I said, but you are at the peak of it, you are going to pay through your nose, and that's really not beneficial. So these all have to come with planning. When there is a new loan that's coming on board, exactly the CFO role is to make sure that, you know, what would be the best mix. The board will give a guidance, so every board should have got a sort of like a structure. Some would be 50%, some could be 70%, it depends on individual boards. So that's where you will see different REITs having different structures and also swaps amounts. For us, we have fixed our interest rates to 63% of our loans. So we still have some floating, which then allows us to enjoy if there is any rates change going in that way. But then again, we are also protected from the huge hikes because of the fixed rates. So I guess that's where it is. In terms of getting bank funding today, it's not that easy, I would say, especially different jurisdictions has got rate hikes. Definitely the banks are a bit more cautious when loans are being extended out. So various forms of debt financing instruments has to be studied through and has to be looked into in order to make sure that that gives the best benefits to the REIT itself. So like Tiow said, you know, it could not be just traditional loans. There is also other things like perps, there is also bonds, or whichever instruments that's available in the market. We should actually look at it and study and see how you can introduce it into the REIT so that you have got a more balanced kind of debt profile as well. So I guess that's where we are at today with this volatile market.
So diversify sources of debt as well, and also liquidity. So you've all got to have committed revolving facilities, committed facilities for the liquidity. At one point, there was some interest in tax structures for overseas REITs, because in Singapore, you know, if you just have Singapore properties, you get all your cash flowing through to the bond because everything is tax-free. And but when you go to US, and I think you'll have experience of that, there are some tax mitigation structures, and you've mentioned one, and in Australia and Japan as well. Perhaps, Chye, you could describe some of them.
Yeah, I think that's also part of the complicated life of the REIT managers. I think the more countries you go into, the more you need to understand and try to comprehend the different tax regimes. What Shaldine mentioned just now about the DISC in UK is one of those, and it is incumbent on the manager to try to optimize all the structures so that if you got assets in different jurisdictions, all of them come back to us in Singapore with the most tax efficient structure. Tax efficient not in the meaning that we don't pay tax, but in the best way in which we can extract as much cash back to Singapore as possible. So like for example, in the UK, you got a DISC listing, so you're treated like a listed REIT in London, except that, it's not even in London, it's in UK, we also don't know where the place is, but it's in so it's called DISC, you know. But what happens is that you're treated as if you are a listed REIT there, but not traded there. So the ultimate trading is still in Singapore. Then in Australia, you have what is known as the MIT structure, Managed Investment Trust. So for that, for example, instead of paying the normal 30% tax, you're paying a 15% tax, right? Then in the US, which is quite common with our US REIT that is listed here, they have the PRE kind of structure, but there's some limitations that you cannot have more than 10% shareholding. So all these are the different kind of structures. They are not illegal, but they are there, and then it's necessary for us to make use of the existing structures there so that we can extract as much of the cash back. And also there's another underlying thing is, what are the tax treaties between that different governments and the Singapore MOF and IRAS, right? In certain areas, it's not very clear. Like for example, now we are sorting out something between Singapore and India. So there's this thing that we are not sure whether IRAS is going to step forward and volunteer to take up the case for us in some of the deals or not. But on paper, as far as what the advisors are telling us, it looks like is something which we can actually look at for tax-free flow back to us. But again, given what happened to this Vodafone in India, everybody is very scared, right? So, but I think that is some of the things. So tax structuring is important, and I think fundamentally, I think the REIT managers will have to engage good tax advisors. And I mean, if you look at the IPO prospectus, there's always a big chunk of stuff on the tax part of it. So, I mean, normally I don't want to read that part because if I read that one, I don't want to invest anymore already. So, because there's a lot of risk factors in there. But now I think the REIT managers need to protect themselves. But most of the time, they will have done their best to ensure that whatever is put as a risk does not happen. All right? And otherwise, Ronald said you're not going to approve the prospectus. Right? So I think as REIT managers, we try our best to ensure that the best tax structuring is put in place, ensure that the constant cash flow comes back to us.
Yes, because Singapore has tax treaties with 97 and 98 countries, and that's one of the reasons perhaps why we can be a hub, an asset management hub, a wealth management hub, also a REIT.
I think,
hub,
I mean,
a REIT management hub.
To Tiow Chye's point, absolutely. When we look at a new jurisdiction, one of the first questions we always ask at exchange when we go to a new market, the US or the UK, the first question we ask ourselves, is there a tax structure that makes us, at the very least, neutral, same as the local REIT jurisdiction there? That is always the number one question that we ask. So, in exchange, I've been working for over 15 years, so we've gone to different, and every time the first question we ask is, are we on par? Can we use it so that investors that invest through the Singapore REIT get the same outcome? And when there is, then we know that we've got a good opportunity. I think the US REIT structure, even a little bit more, I would say, much more optimal in the tax outcome than perhaps over for US investors. So there's a lot of safeguards. The managers themselves go down to it. I remember the UK when we first started, it was a bit of an adventure because it was novel, not tested in terms of using the UK REIT structure. So thankfully, Cromwell took up the, Elite took up the challenge, right? And basically championed our cause. But sometimes it's going there and talking to the tax advisors and saying, what is the right structure? So certainly for Mapletree, they have everything in different jurisdictions. And I think we're probably the few REIT jurisdiction where you can find REITs that have, I was joking, underlying you have a UK REIT, you might have a MIT there, you might even have a TMK, TK structure, but that's really what we do to ensure that you get the best outcome.
I guess maybe just adding on as a foreign REIT, not only dealing with IRAS, which is definitely not easy, is that for us, we have got to deal with HMRC and trying to convince them that the structure that we put upon, it's something that's acceptable. Agreeing to say that, look through to Singapore SGX to say that, that's where the investor pool is. So these are all the challenges that we are, as a REIT manager, we have to go through. And it's definitely something we believe is worth doing that because that helps us to get a better return for unit holders. We do away with corporate taxes. We are not worried about, like previously under Boris Johnson, they want to increase corporate tax to 25%. And then now Liz Truss comes about and says, okay, I'm going to cancel that and go back to 19%. We're done away with all this. We don't have to pay the corporate tax. So I think that's a structure that we believe helps us. Now, underlying fundamental, other than tax payments, other than bringing back the money back to Singapore, better than a structure which doesn't have this, is also the competitiveness. We need to be as competitive as a UK REIT, especially when we are buying properties, when we are selling properties, because the structure itself doesn't only covers the fact that how much tax you need to pay. It allows you to look into things like, how I actually book my assets value when I took it into a listed REIT, basically a UK REIT. I'm able to rebalance that. So when I sell any properties in future, if I do, I'm able to, the buyer will be able to see that when I buy it, they don't have to pay that much of a profit in terms of capital gain tax. So people are more willing to look at and bid it. So these are all these minor little things within the structure when we embark onto such exercise. So as a REIT that has got foreign assets, these are the challenges that each and every one of us are facing every day.
Okay, so staying with structures, lease structures and inflation. So perhaps staying with you, Shaldine, has inflation affected your NPI in any way? And what sort of lease structure do you have for your assets?
Okay, I guess Elite is slightly unique. We have always said that, rather than a pure commercial REIT, we are a bit like a social infrastructure REIT. All our assets are actually led to the UK government, except for the few assets which constitute less than 1%, which are actually
one
just...
of them is a pub.
Yeah, it's like sandwich shops and pizza place and the pub that's below the office.
A tanning shop.
So apart from that, everything is led to the UK government. Now, the UK government is responsible for the entire building. So it's led on a structure called the full insurance and FRI basis. So basically, they take care of all the operating maintenance costs. They take care of any repair costs. If there is anything such as replacement of boilers or window panels, everything else is actually borne by the government, not by us. So in a way, the inflation, which particularly the surge in utility costs, did not affect Elite commercial REIT. So fundamentally, we are not impacted by this. At the same time, because we have got a built-in rental escalation that is linked to inflation, so we have got an escalation that's coming up by the second quarter of next year, which is 1st of April 2023. That has got a structure whereby we compound the CPI over the past 5 years, starting from 2018 when the leases were signed. So every year we compound the CPI. However, I guess the catch is that it's not the current CPI, so there's a floor and cap to it. We have a 1% floor and a 5% cap, which means that if it goes beyond 5%, we only can get a maximum 5% increase. And of course, like during COVID period, when it's below 1%, we have at least 1%. So that builds in. We do expect a double-digit increase in rental escalation coming next year. And so I guess inflation, in a way, is beneficial in this particular context to us.
Okay, so I've been shown some questions from the floor, but before we get to it, can we still stick with the lease structures? Chye, there are master leases, single-tenanted leases, and multi-tenanted leases, and there's some others under the data center. You have the Shell and Chye and so on.
Yeah.
Could you just tell us a little bit about the multi-tenanted leases and the single-tenanted leases and the master leases, quickly, the differences between them, and what investors need to look out for when they're looking at a REIT to invest in?
Yeah, I think as Shaldine mentioned, her type of leasing structure is one of those many that's in the market. In a way, hers is what we would call a net lease kind of structure, or in the UK context, FRI, so that the tenant bear all the operating expenses, except maybe for insurance and prop tax and whatever, but all the other operating expenses are borne by the tenant. So in this case, it's the UK government. So it's a question of whether you believe they are good tenant or bad tenant. So far, so good. I think they're okay. So, but in other commercial contexts, you can have a multi-tenanted building, meaning that it's like an office building, you've got 50 different tenants in there. So in those cases, it's usually a gross kind of lease, meaning that the landlord will pay for everything, including the utilities, air conditioning, whatever, and they will charge it back to the tenants on a service charge recovery basis. Sometimes they make money out of it, sometimes they don't make money out of it, right? So that is a part where it is a gross lease. And these are the ones that sometimes in today's context, because of utility cost escalation, that's where the additional cost will come in to hit into the landlord's expenses. And most of the time, they will try to hedge it by having long-term energy contracts. So you are protected to a certain extent. Unfortunately, when these contracts run out, the new contracts that come in, if you want a fixed one, it's going to be very expensive. So a lot of times, even the energy providers don't want to sign new contracts on a long-term basis with you. So those are the gross leases. There are quite a few of what is also known as a double net, triple net kind of leases, where all the expenses are paid for by the tenants. And these tend to be those that take up the whole building, right? So what you actually do own is building the building rental as if it's a net rental, then the expenses are all carried by the tenant itself. So there's less of a risk in terms of escalating expenses cost, but there are pros and cons to this thing, because those normally you will apply to either single assets or smaller asset, or you do what is known as a sale and leaseback, right? Where someone that is an operating business has also got a property. They say, I sell you a property, I will lease it back. But because I know my property best, I want to operate it myself. I will pay for my own maintenance, landscaping, utility. You just pay me as if you just buy the shell, all right? So in the case of like data center, it is quite common that it is just what we call a core and shell kind of lease, whereby we only own the core and the shell. Right? All the servers and all the racks inside there, plus all the utility costs, are all borne by the tenant themselves. And this is something that for MIT, they do most of their US assets on, because to be fair, and I think to be truthful, the MIT guys are good guys, smart guys, but they are not server operators. They don't know much about how to operate a computer, right? So those we leave it to the operators who are the specialists in that area. So we only know real estate, so we take care of the real estate, including maybe the standby generator set, maybe the air conditioning, capex. But the operational inside is very much the operator's issue, so they bear the cost of that part.
Okay, so we've got a few questions from the floor, and they're all they all appear to be directed at Shaldine. And okay, the first one is on her leases.
Right.
I think she can see the question. It's yeah. So with some of her leases, the leases at Elite Commercial REIT, when it first listed, had a break clause at 5 years.
Yes.
They're 10-year leases, but they had a break at 5 years, which you have got over.
Yes.
Yeah, so I think the question is...
so the question actually
is the DPU secured?
So basically, I think the question is asking, since I've removed the break options from 85% of my asset, will Elite also have a DPU that's secured for 85%. I guess, just like what Chye has mentioned earlier, in our balance sheet, there are certain items. So I would say that at least when we have removed the break options, the revenue that's coming from this 85% of the assets is certain. So there's no other way the government is able to exit the property, which means that they will continue to pay the rental for these assets. Now, DPU has also got other components that is affecting it. Things like what we have discussed just now, the interest costs. For us, I think operating costs is quite minimal because of the structure. But there is also other things that, as a REIT manager, we will also need to consider and look into. Like what we have recently done is that we have actually do a sustainability contribution, but that is actually using our balance sheet rather than our P&L. So over time, I can't guarantee to say that by 2028 every year I can secure 85% of my DPU as what it is today. But with the securing of the lease breaks options removed, I have a certainty of my top line. The manager's role is to make sure that we can actually manage our costs in the most effective manner so that we can actually generate the best DPU outcome for our unit holders. So that is the agenda of the REIT manager to achieve over a period of time, until 2028, like what the question is saying.
Until 2028. Okay, the other question that, of course, is the value of the pound, okay? So there's this question. Look, Shaldine cannot answer about the price, because the pricing is the market. And so the questioner says, there's the fall in the pound, the fear of office property, low percentage of fixed debt. What are the other risks you see? Okay, I will answer that one. Okay, the main risk for a lot of REITs is the yield spread, because REITs take their pricing off the risk-free rate. Singapore's risk-free rate has gone up a lot. It's like 3.2 to above 3.2% as of last week. The gilts, which is the British pound, okay, it's at 4%.
The 10-year yield. 10-year.
Yeah, the risk-free rate. The risk-free rate's 4%. In the US, the risk-free rate, I think it was at 3.57% as at last Friday. And so when you, yeah, I know, so it's telling me time's up, but it's like this. When the rates were right at rock bottom, the REITs were yielding like 5 to 6%. So that's your yield spread. So you've got to work out what the current yield is likely to be for your REIT, and then work out the price from there. So the point is that if yields expand, the prices have to come off, or your DPU grows so much that it maintains that yield. Right, so what are the other risks you see? I mean, apart from the yield spread and the 10-year risk-free, what are the other risks?
Well, I think the impact on the high interest rate, I think every one of us knows about it. So the relative yield spread in that particular country is affected by what you can buy the asset for versus what is a 10-year risk-free. And as Gula mentioned, the higher is the risk-free, the higher you require the yield spread to maintain the same yield spread, which also means conversely, the property pricing should go down. And that is reflected in where the REIT prices are today, which is easily 10-15% below where we wanted it or since the beginning of the year. But I think the bigger picture that we are facing today are things that you hear about every day, the geopolitical problems, the supply chain problems, what is China doing in terms of its COVID policies. So all these are all coming together. I think we are in what we call the perfect storm at the moment. But hopefully now we can see some rainbow at the end of the sky. We don't know when, but we certainly are not in dire straits today. Now, as Ronald mentioned, we are a lot stronger today than the last crisis, right? And I think with the institutions and support that we have from the banking and the investor world, I think we're in good state. Whether we can buy today is a question of whether who's got a stronger power, the buyer or the seller. And you'll be foolish for any REIT managers to try to buy something today if he doesn't think that he can raise both equity as well as debt. All right. So I think that's where we are. The gearing now on the average on the S-REIT is less than 40%. We are very healthy. Now we still got 10% headroom, but obviously nobody's going to use up that 10% headroom because you all need to watch out whether at the end of the year is there going to be a valuation takedown, right? Because of all this revalidation of where the cap rates are.
Okay. So I think we have to, I'm told we're out of time, so the last question. The last question is, sorry, Shaldine, it's back to you, the sharp fall of the pound, because that really came off in the last 2 days. So
yes, I think it's hot from the oven. The pound has been falling since Friday when the mini budget was announced. So I guess for us, because we are actually paying our dividends in pounds, so technically as a REIT, there is no currency mismatch. Of course, the question probably comes from investors who will probably be, converting Sing dollars. So, we can't really control that part of it. It depends on each individual investors. Some has got Sing, some has got pounds. So in terms of, the kind of risk that investors are looking at, it varies from one to another. But what I can, say is that fundamentally, these pound structure up and down, inflation's coming up and down. It's something that the REIT manager couldn't control. What the REIT manager can control is actually how to manage the REIT properly and make sure that the fundamentals that you have in the REIT is strong. The fundamental stays, and you can actually then, over time, you will be able to weather through this, what you call perfect storm. So that's where I think it's more important as a REIT manager what we need to focus. So we should not be diverting our focus away from what we need to do best, which is to manage the property and to manage your structure in terms of financing. And that's where we can only say, that's what we are looking at. But for a 52-week low, unfortunately, we have been impacted by the fall in pound.
We're all affected, yes.
Yes. So, but it's going to be a knee-jerk effect.
Yes. So, okay, we need to ask Chye what Mapletree Investments is planning What sectors, what countries are you interested? There was a question on what's going to be your next IPO. And there's also a question on whether MIT and MLT are going to merge.
I didn't ask
the
question.
Any words before we leave?
I thought time's up already.
Yeah, time's up.
Okay, I mean, in short, okay. The first question was whether we ever consider merging MIT and MLT. Firstly, let me say that the questions of merging doesn't come from the sponsor. All right, merging has to come from the board of directors of the two respective REIT managers. But from the sponsor's perspective, we don't see any compelling reason for the two REITs to merge, because each of them have got their own growth perspective. And I think the runway for both of them are quite big. For MIT, we are talking about high tech, we're talking about data centers, we're talking about business parks, and there are plenty of this still around globally. For MLT, they have been in a region for many years, right? Question is whether we stay as an Asia Pacific MLT, or do we go global? So there's a question for the board to take. So in short, we have, from sponsor's perspective, no reason for us to merge. Second question is, what are we looking at in terms of other asset classes? Now, as Gula mentioned, we are quite big on student housing. Whether we can lease or not, we try to lease, right? But market not in our favor, so we are holding back on that listing. We see whether there is still an opportunity or not. Other areas that we are doing is not so much in the listed REIT area, but we're doing a lot of logistics development in China, as well as logistics investments and development in the Western world, in US and in Europe. So these are the two asset classes. So our strategy is very simple. It's beds and sheds. That's all. And maybe a bit of fur, because we're quite big in Vietnam as well. So that's it, bed, sheds and fur. That's it.
Right, thank you very much. With that, we've come to the end of today's session. Thank you once again, all our panel speakers. And thank you, on-ground audience, and also those of you joining us on Zoom.
Thank you.
Right, so we have a survey. Help us do better by filling out the survey. And we also have an annual REITs forum on the 29th October. So, yep, QR codes on the screen. Right, we have arranged for some refreshments, but by the look of it, some of you already know. So, my name is Kavi from The Edge. Good night.